Hi everyone and welcome to Symax Fintech Weekly Market Insight. As usual, just start with our disclaimer. So trading involves potential risk of loss of capital and is not suitable for everyone. Hopefully for you though it is. And just be wary of leverage as you can lose substantially more than that initial investment. All the views, opinions, everything contained in this is just purely for educational purposes. We're not giving or providing advice or encouraging you to trade or invest. That has to be your decision. You should carefully consider the risks involved, your financial situation most definitely, level of experience and risk appetite also, and you should only risk capital you're prepared, but more importantly, that you can afford to lose. If you've got any doubts whatsoever, then just seek some independent financial advice before you risk that capital. All we're trying to do here is just prepare you for the week ahead, just give you a little bit of an insight, our insight that is. Okay, so when we look back at last week, the markets reacted positively to Powell's speech. All the assets were rallying, except for the dollar and the yields, they dropped. And then Thursday, PCE, one of the Fed's preferred metrics, again added confidence to investors, but of course only for that to be dampened on Friday with the stronger than expected employment data that came out. PCE core 5%. So, there's still a lot of work to be done. The central banks want to see that at 2%. China lockdowns, they just seesawed. So yes, cases are at record levels. People are very unhappy about being locked down. And of course, those lockdowns to ease the pressure on the economy. And then now taking into account that more people are vaccinated. So rather than continuing with sort of these regional lockdowns, it seems that they're going to allow for more self isolation, although that will lead to more stringent testing just to make sure people, if they do have COVID, aren't going out and spreading it. USD was still under pressure, as I mentioned, and of course with treasuries reacting to the data, easing. They steadied right at the end, obviously after the NFP data, but the dollar's had quite a considerable move from its highs now. If you look at the Dixie, sort of above 111 down to sort of below 105. Is it going to continue? For me, the US still has the strongest economy, so we'll have to wait and see. Stocks finished the week higher, as did oil and gold. Inflation data from China was at levels most central bankers would give their or someone else's right arm for. Although for China that's considered to be a contraction, which is a concern to them. They're used to having much higher numbers. And of course, leading to the easing of their COVID zero policy as well. But we'll have to sort of just see how that goes because they tend to change their mind quite quickly on some of these things. In the EU, they managed to set a price cap for Russian oil of $60. Now, the fact there is Russia going to be happy with that? Will they accept that? Do they need to actually export oil to Europe is the big question. They've got India, they've got China, they've even got the Saudis. So they've got lots of other areas and countries that they can actually export to. So will that bother them too much? Of course, for Russia, they could decide to actually reduce supply and force prices back up again. And of course, if the EU can't buy oil at $60, what will it do? Is it going to run out of oil? I don't think so. And just the last thing, the US rail strike has been cancelled. So key data this week. We've got plenty of PMIs out, as you can see everywhere. and that will provide a little bit of insight into the economies and how businesses see the economies going. But also in the US, we've got PPI and Michigan sentiment. So we'll see a little bit from the consumer side, and we'll see a little bit from inflation data as well. For the EU, also, they've got the PMI releases along with employment data and GDP. Rate decision from the Bank of Canada, 25 or 50. I probably expect it to be 50 at the moment, but we're again, who can tell? Japan also has GDP, and that's along with China, and China's providing more inflation data, and also Australia releases its GDP. So not too much out next week. Okay, so moving on to the macro outlook. We're rapidly approaching the end of the year, Christmas, etc., etc. We're also rapidly approaching the final central bank meetings for 2022. For the Fed, I'm expecting a 50 basis point increase. Although there was the sharp drop in Treasury yields and the US dollar, that will be a little bit of a concern because that could give another boost to inflation. The Fed will take that into account. I expect Powell to really emphasize that there are more increases to come and that the rates will stay higher for longer. For me, investors are sort of ignoring this a little bit. With a recession on the horizon, I think that unfortunately, they're sort of seeing this as a sign that the Fed will slow down or even stop their rate rises rather than force a recession. However, for the Fed, it's all about inflation. And if it takes a recession to regain control of inflation, it's a price that the central banks are prepared to accept. These rates are going to stay higher for longer. I've seen them much, much higher. But the point is, these really cheap money that we've seen, that's gone for the moment. That may have gone for a long time, because even at the next crisis, the central banks are going to be reluctant to cut rates too quickly. This inflation has really panicked them, it's frightened them, and they're going to need to be careful how they go about this in the future. Quantitative easing, as I always say, is the easy solution, not the best. But as I mentioned, they are prepared to create this recession if necessary because they need to reset the economy. And then with those rates staying higher, they obviously will hope that inflation will drop and be beaten because demand will slow down. A few other things to consider is China may help. If the lockdowns are reduced, then supply chains could improve. The thing we should remember is that most of the inflation is from the supply side. So regardless of how high rates go, it's only going to impact demand. I would say for the central banks, they're hoping if they can slow demand, then that will balance with where there's been that lack of supply. Of course, we've still got that lack of workers, which means that there's still wage pressure, and that's going to remain. And you know what? Even when the recession hits, the big question is going to be, will companies risk laying off that staff that they've taken on when they've struggled so hard to find them this year? I think the only exception is probably the tech industry. We've seen a lot of people let go in that, and that's understandable considering they had such a great run during COVID, but now with people more concerned about their disposable income, many will actually just hold on to last year's models rather than replacing their phone or laptop or tablet. Thing I would say watch in Europe would be the temperatures, because I believe that they're going to play a big part in inflation which will include and have an impact on the euro and the pound as well. You know, because if temperatures start to drop as they've started to, I'm in the UK, and they continue to go lower, that's going to put more demand on the gas reserves that have been stockpiled so far. And then if they have to go back in to replace those, you know, that could spike up gas prices again. You know, there are caps in place, but even so, you know, it's more and more pressure all around Europe if temperatures drop. Now, you know, we've seen these lockdowns. Trump even attempted to reduce the US reliance on China for imports. But surprisingly enough, even with the lockdowns, even with those attempts, we're seeing that the US are at record level imports from China. So that is, you know, not working as they expected. But, you know, yeah, COVID did sort of highlight our reliance on other countries, and you know, slowly but surely, a lot of countries will try and address that and rely more locally for where they can access certain things, such as semiconductors, for example. Global inflation may have peaked now, around about the 9.8%. That's an average, of course, and it's dropped down. It's probably now close to about 9.5%, and it's expected to drop considerably more next year, probably below 6%. But you know, when you look at these numbers, they're still higher than the 2%. So I really do not see these central banks giving up so quickly and easily. If they need to keep adding, okay, they're going to slow down. You know, these aggressive 75 basis point hikes, etc. Yeah, they may disappear. We'll see some 50s, then we'll move on to 25s. But as that data keeps coming through, if they need to do more 25s and more 25s, you know, don't put a limit on them. They could keep coming for the moment. Uh, for me, it's all about that inflation. They need to beat that, and it's going to be at whatever that cost happens to be.